Stocks on the move here as the NASDAQ takes leadership and big tech gives us a platform on which to rally again. In addition to, of course, in line to a little soft CPI always helps. John Kosar joining us from Asbury Research, Chief Market Strategist. John, welcome back. Good morning, sir.
Good morning to you. Good to be here.
Hey, you've had green on your indicators, so I guess you're not surprised by the strength this morning. Tell me what you're seeing.
Well, I mean, obviously, the Asbury 6 can't tell what the CPI number is going to be or any other indicator, but they can tell you how the market's leaning, how the market's feeling. And the Asbury 6 switched back to positive on May the 3rd. So we've been in the market, showing up there on our screen. You can see that most of, well, let's talk about the 6 real quick. There's 6 different indicators. They're pretty disparate. I want to look at the market from all sides, kind of under the hood, look at the market and not be chasing the tail of the S&P when it's up 50 in the morning and down 50 at night. So we've got the rate of change in the S&P, relative performance between stocks and high yield bonds. We have investor asset flows. We have volatility, trading volume, and market breadth. Those 6, if you look at, well, first of all, you can see they're all green. It means they're all positive. They're all conducive to the market going higher. And you can see that most of them turned right in that first week of May. We got May 3rd up here, and then May 6th for the relative performance of stocks and bonds, 5, 6 after that. And then the 2 at the bottom, volume and breadth, are also 5, 2. So you could look at that and say that the internal condition of the market really flipped back to positive within that 3 or 4 day area.
Yeah, the start of this month seemed like we kind of turned on a dime there, both from Eurometrics, the Asbury 6, and just kind of the way the market traded once we got back into the 5 handle for S&Ps. It's pretty much gone just straight up. So 6 metrics all pointing green with breadth, trading volume, volatility, flows as well, and then of course the performance there, kind of the last to kick in for John's Asbury 6, the May 6th for price performance to be the kind of final piece of the puzzle to fall into place. So your Asbury 6 flipped positive basically first week of May here in its entirety. John, walk me through the levels that you're looking at here. Is there any way to project where we might go based on where we've been now that we're breaking back out?
There is a target that I have in the Dow 30. It's based on a chart pattern, and I'm pulling it up here real quick on one of our screens in the office here.
Yeah, go ahead.
So we've got 41,500, and we're at 39,709 as we speak. So the next target for me, and again, I don't have a target for the S&P 500 or any of the NASDAQs, but I do have one for the Dow. And generally, there's a linear correlation between all of those. So if you say, where do you think the next stop is? It's probably 41,500 area in the Dow 30.
All right. I mean, hey, that's a pretty good little chunk away here, right? So we've got some room to run, it seems. Sector-wise, we've had a couple interesting weeks, John, where the utilities were real strong. It was kind of a curious, almost defensive-like nature to the rally. Does that shift, you think, now that we're at highs, or what's kind of the leadership breakdown you see?
We try not to predict as much as we just try to read the data. So last week, our SEAF model, our sector ETF asset flows model, which should have a graphic there, of the top 3 that had the best SEAF ranking, which means the acceleration of money was fastest in multiple time periods going into those. 2 of the 3 were utilities and staples. And then there you see financials, utilities, and staples are the top 3. Utilities and staples are obviously defensive places to be. Then if you look at the bottom, those are the worst ranked sectors. Of the bottom 4, 3 of them are offensive. You have technology, communication service, and consumer discretionary. So what does that tell me? It tells me even as the market is making new all-time highs here, internally, inside of the market is generally hedging its bets, so to speak. So in other words, major averages are setting all-time highs, but the configuration of the money underneath there inside of the S&P 500 is defensive. How do I read that? I think managers are looking like, hey, we've got to participate in this, the FOMO kind of thing. But if we're going to participate, maybe tilt our portfolios a little more defensively. So if there is an unexpected reversal lower, we're in the right places. That's what makes sense to me.
Okay. So as long as we've got, trends in place for tech, it's okay if, we get a little different leadership, as long as it seems like tech doesn't go, red on your model. That's because that's kind of our backbone still, the chip makers, that whole sector. But it goes to show that we can get up to these levels without that group necessarily carrying us, because the strength has been more bank, more utility, almost staple oriented.
Yeah, banks are actually breaking out this morning. I was just looking at a couple of ETFs that follow the banks. We're looking at banks and also the regional banks, KRE. Those are breaking out of sideways patterns that we've been in for months. So the financial area does look strong. And what you said is right. The comp, the NASDAQ Composite Index, which is the larger of the two NASDAQs, that's breaking pretty important resistance level. I actually have a chart there with you guys this morning. There it is. You can see we're challenging the high from back in November of 2021. We're starting to take it out. So looking at the sector rotation, I don't think that you can go for a long period of time and having technology in the bottom four, according to the CEF model. So that's just telling me, even as the market is making new, it's not normal either. I mean, this is not a usual occurrence. Normally, if we're making new all-time highs, you're seeing technology and discretionary and services up there at the top. You don't see that now. And I think it's because the market's up 30% since October of last year. And I think a lot of people that manage money for a living are saying, hey, listen, we want to make sure that we squeeze every inch of this out that we can on this rally, but let's not get too far over our skis and maybe trying to participate with putting on a little bit of a hedge in case there's a downside reversal. That's what makes sense to me right now.
So that seems like then this could be a little bit more of a kind of a turtle than a hare if we are breaking out, to kind of use that analogy, because when tech and momentum is ripping out front, that's a very fast moving bullish market, whereas you can have a bullish market, it's just moving a little bit more slower. That might be some of the leadership we've seen in the utilities, the banks. Now, if that shifts, then of course we start racing, but it seems like right now kind of a grind is more in the cards.
Yeah, and it's been a weird year. This year has been really unusual ever since about the second week of January, when AI really took off. And you saw companies like NVIDIA that were breaking old highs and everything really took off from there. You've seen this odd rotation where it's everybody into the pool for 2 weeks. That's all of the usual suspects are leading, discretionary and tech. 2 weeks later, you'll see that money kind of flush into staples and utilities for a week or two, and then the market seems to get its bearings back, and it's right back into those faster horses again. So this has been kind of a phenomenon that we've seen all this year. And again, I think bigger picture, it's because the market has come so far so fast. I mean, 30% since the latter part of October. That's a long way to go. The market's overextended according to a lot of different metrics like sentiment, standard deviation, and stuff of that nature. So I just think you have to keep watching the Asbury 6 and make sure the internals are strong on a day-by-day basis. And again, by watching the rotation according to the CEF model, it really tells you which parts of the market are the most in favor on a week-by-week basis. And it helps me to understand kind of what's going on underneath the surface.
All right. Helpful as always. Thanks for the analysis, John.
Thanks. Good to see you.
All right. Have a good one. John Kosar, Chief Market Strategist at Asbury Research, with the green Asbury 6, giving us the all clear stocks breakout.